By the 270s AD, the Roman denarius, once 90% pure silver, had been secretly reduced to less than 5% silver, and almost nobody knows this happened deliberately. That decision, made by a succession of emperors over roughly 2 centuries, is still affecting the purchasing power of every dollar, pound, and rupee in your wallet right now. By the end of this, you will understand exactly how governments transfer wealth from citizens to themselves without raising a single tax, and you will never look at inflation the same way again. Think about the last time something you bought regularly became noticeably more expensive. Groceries, fuel, rent. You probably searched for an explanation and found one that pointed outward. Supply chains, global events, market forces. The explanation rarely pointed inward, toward the money itself. But what if the price did not go up? What if the money went down quietly by design while you were not looking? This is not a new problem. It is not even a modern problem. It is one of the oldest financial mechanisms in recorded history, and it was perfected inside one of the most powerful empires the world has ever seen. The people it happened to did not fully understand it either. They just knew that their savings bought less. Their wages stretched further yesterday than today, and the explanations they were given pointed outward too. To understand how we got here, we need to go back to Rome in the 3rd century AD. In the early days of the Roman Empire, the denarius was real money. Under the Emperor Augustus, who ruled from 27 BC to 14 AD, the denarius was approximately 90% pure silver. It was a coin that merchants accepted without hesitation across thousands of miles of empire, from Britain to Egypt, from Spain to Syria. Its value was not a matter of trust. It was a matter of chemistry. You could weigh it, you could test it. It was what it claimed to be. The Roman Empire at its height was an extraordinary logistical achievement. Armies had to be paid. Roads had to be built and maintained. Grain had to be imported and distributed. Borders stretching across 3 continents had to be defended. This cost enormous sums of money, and for a long time, the empire generated enough tax revenue and trade wealth to cover it. Then came the 3rd century. Between 235 AD and 284 AD, a period historians call the crisis of the 3rd century, the Roman Empire faced near simultaneous pressures that would have broken most states entirely. Military invasions on multiple frontiers, a succession of emperors who came to power violently and died violently, with more than 50 men claiming imperial authority during this 50-year period. Plague, famine, economic disruption on a massive scale. Armies still needed to be paid, wars still needed to be funded, but the tax revenue that had sustained the empire was fracturing along with everything else. The emperors faced a choice every government in history has eventually faced. Raise taxes on a population already under pressure and risk rebellion. Cut military spending and risk invasion. Or find a third option, one that is quieter, harder to trace, and politically invisible. They chose the third option, and what they did next changed the nature of money itself. Here is where it gets interesting. The mechanism was almost elegant in its simplicity. When a coin is minted, you control what goes into it. The Roman state controlled the mint. So, rather than collecting silver from citizens and returning it as coins at face value, the emperors began collecting the same silver but returning slightly less of it in each coin, blending in copper or other base metals to make up the difference in weight and appearance. The coin looked the same. It weighed roughly the same. It had the emperor's face on it. It said it was a denarius, but it contained less actual silver each time it was minted. Think of it this way. Imagine you run a bakery, and you slowly begin reducing the amount of flour in each loaf, while keeping the price the same. The loaf looks similar. Customers keep buying, but each transaction invisibly transfers a little more value from the buyer to you. Now imagine doing this across an entire empire with every coin, for 200 years. The silver content of the denarius fell from roughly 90% under Augustus to around 50% by the reign of Septimius Severus in the early 3rd century. Under Emperor Gallienus, who ruled from 260 to 268 AD, it had collapsed to somewhere between 2% and 5% silver. What had once been a silver coin was now, in practical terms, a bronze coin with a thin silver wash applied to its surface to maintain the illusion. This is the part most history books leave out. When coins containing less silver flooded into circulation alongside older, purer coins, something predictable happened. Merchants and citizens are not unintelligent. They could feel the difference in weight. They could scratch the surface and see the copper beneath. And so they began to hoard the older, purer coins, keeping them out of circulation, while spending the debased newer ones as fast as possible. This behavior has a name today, Gresham's law. Bad money drives out good. When two currencies circulate together, and one is clearly worth more in its physical composition, people spend the inferior one and save the superior one. The inferior currency dominates daily transactions, while the valuable currency disappears into mattresses and buried jars. The practical consequence was rapid and severe. Merchants, understanding that the coins they received today were worth less than the coins they received last year, began raising prices to compensate. Not because goods were scarcer, not because of supply chains or global events, because the unit of measurement had been quietly corrupted. By the time Emperor Diocletian took power in 284 AD, prices across the Roman Empire had risen to levels that threatened basic economic function. In 301 AD, Diocletian issued the Edict on Maximum Prices, a sweeping imperial decree that attempted to legally cap prices on hundreds of goods and services across the empire. It was one of history's first recorded attempts at price controls. It largely failed. Merchants who could not sell at the capped price simply stopped selling. Goods disappeared from official markets and reappeared in informal ones at whatever price buyers would actually pay. The mechanism had already done its damage. No decree could reverse the loss of trust in the money itself. The people who suffered most were not the wealthy, who held land, property, and gold. They were soldiers paid in denarii, laborers paid in denarii, merchants whose savings sat in denarii. The debasement was, in effect, a tax that fell hardest on the people least able to avoid it, and who least understood what was happening to them. Now look around you. No government today is shaving silver from coins. The mechanism is more sophisticated now, but the structure is identical. When a modern central bank expands the money supply to finance government spending, it is doing what the Roman mint did. It is introducing more units of currency into circulation without a proportional increase in the goods and services those units can claim. The result over time is that each unit of currency claims slightly less than it did before. The cost does not appear on any tax bill. There is no line item labeled inflation surcharge on your paycheck. The transfer of purchasing power is invisible in individual transactions, visible only across time, when you notice that the savings you accumulated 5 years ago buy noticeably less today. Modern governments that expand the money supply to finance deficits without raising taxes follow the same structural mechanism, distributing the cost invisibly through inflation rather than direct taxation. You pay, you just never receive an invoice. The people who survived this mechanism today are the same structural category as those who survived it in Rome. Those who hold assets, property, commodities, anything whose value is not denominated in the inflating currency, are insulated. Those whose wealth exists entirely as cash savings or fixed wages bear the full weight of the transfer. Gresham's law still operates. Watch what sophisticated investors do when they lose confidence in a currency. They move toward hard assets, toward commodities, toward anything that cannot be printed. The behavior is the same. Only the era has changed. Diocletian tried to fix the problem with a decree and failed because the damage was already structural, already embedded in the money itself. Modern equivalents of his edict on maximum prices, attempted government interventions in prices that have been inflated by monetary expansion, have produced similarly predictable results across dozens of modern economies. The mechanism is not a secret exactly. It is documented in every serious monetary history. It is discussed in central banking literature. What it lacks is visibility at the level of the individual citizen going about daily life, watching prices rise and searching for explanations that point outward. The Roman denarius did not die in a single dramatic moment. It was not stolen in a raid or destroyed by an enemy. It was hollowed out, slowly, deliberately, percentage point by percentage point, by the very institution that issued it. The mechanism did not disappear with Rome, it evolved. And the real question is not whether it is still running, it is whether you can see it.